friends, welcome to yet another session on hedge accounting. And in this session, we are going to cover fair value hedge. So let's begin. Guys, before we discuss in detail about the fair value hedge and how to account for the fair value hedge, it's important for us to understand the basic concepts on the financial instruments, which we have already covered in the previous videos uploaded on our YouTube channel. We uploaded two videos on derivatives. In the first video, we covered the forward and the futures contract. And in the second video, we covered the options and swaps. Why this becomes relevant to understand this the session on fair value hedges? Because we'll be covering the accounting on the fair value hedge with an help of an example. An example would cover a derivative. In another set of videos, we covered the classification of financial assets and liabilities. Why this become important is because we'll be seeing the how to account for the hedged item and hedging instruments. Hedging instruments can be a derivative and hedged item can be a financial asset and financial liabilities. So it becomes important to understand the classification of financial assets and financial liabilities before we understand the fair value hedge accounting. In the hedge accounting part one, we discussed the basic elements of hedging, and on the hedge accounting types of hedges, we understood that there are three types of hedges. One was the fair value hedge, one was the cash flow hedge, and the third one was hedges of net investment in a foreign operations. So unless and until we are clear with the basic concepts on derivatives, classification of financial assets and liabilities, and the types of hedges, we won't be able to understand the fair value hedge in accounting on fair value hedge. So it's become easy. If you have already seen those videos, it will be very helpful to understand this session. In case you haven't, we have in the subsequent slides a glimpse of what all we discussed in these videos. So let's see what all we discuss in these videos, and then we'll discuss the fair value hedge. So guys, in the video on the financial instrument, or I should say the classification of financial instruments, we discussed that there are three types of financial instruments: financial assets, financial liabilities, and another one was equity instruments. Though we are not going to discuss in detail, but we'll see how the financial assets and financial liabilities were classified. So financial assets were classified either at amortized cost or at fair value through other comprehensive income, that is OCI, FVT, OCI. And then there was a third classification, fair value through P&L, that was FVTPL. And financial liabilities were classified either as amortized cost on the fair value through profit and loss accounts. So in those sessions, if you remember, we discussed that there will be two criterias, or the the factors which we need to consider. One was on the SPPI test, solely payments of principals and interest, and one was the business model assessment. So if case my business model was to hold the asset to collect the SPPI, solely payments of principals and interest, then my financial asset would be classified as an amortized cost. If my model was to hold the asset and sell the asset and to collect the SPPI, that is solely payments of principals and interest, then it would be classified as fair value through OCI. And all the residual categories will fall into fair value through profit and loss account, and the same thing goes holds good for the financial liabilities as well. So guys, financial assets either at amortized cost, fair value through OCI, or fair value through P&L, and financial liabilities will be classified either as amortized cost or fair value through profit and loss account. Guys, we also discussed the derivatives. We discussed futures and forward contracts with the help of an example, and we also discussed the options, which is a call option and a put option, and also the swaps, interest rates and swap, and currency swap with the help of an example. So I'll recommend that if you can go and revisit those videos, it will be helpful for you to understand the fair value hedge account. In another video, we discussed what an eligible hedge item will be. An eligible hedge item can be a recognized asset or a liability, a highly probable forecast transaction, an unrecognized firm commitment, and an investment in a foreign operation. So hedge accounting can be a single item and it can be a group of items. And also hedge accounting can also be a component of such items. And we also discussed that hedge item must be measured reliably, right? So in another video, in the last video which we uploaded, we discussed on the types of hedges. One was the fair value hedge, which was the hedge of exposure to changes in fair value of the recognized asset or liability. Cash flow hedge, as the name suggests, it is the hedge of exposure to variability in cash flows. And in case of net investment in a foreign operation hedge, an entity might have an overseas subsidiary, associates, or a joint venture. And while consolidation, there can be a currency risk associated with the translation of net assets of these foreign operations in the parent entity's functional currency. As such, it becomes important to hedge the currency risk associated with the translation of net assets. So, guys, we also discussed in brief that the gains and losses in case of a fair value hedge on the hedge item and the hedging instrument will go to profit and loss account. That was the general rule which we discussed. In this video, we will also discuss the exceptions related to the fair value hedge. In case of a cash flow hedge, all the gains and losses on the hedging instrument, I said hedging instrument and not hedging item, all the gains and losses on the hedging instrument to the extent these are determined as an effective hedge will be recognized in OCI. And if the portion of these gains and losses which are determined as an ineffective hedge will be taken to profit and loss account. The same accounting treatment will hold good in case of a hedges of net investment in a foreign operations as well. So guys, with this quick recap of what we have already discussed in the previous videos, let's now discuss the fair value hedge and the accounting of fair value hedge. Yes, for the accounting of fair value hedge, we will break these into the the accounting for the hedge item and the accounting for the hedging instruments. So let's first discuss the hedging instruments. As a general rule, as a golden rule, hedging instruments are always measured at fair value, and a hedge item can be measured at amortized cost, fair value through P&L, or a fair value through an OCI. But however, hedging instruments are always and always measured at fair value. Hedged item can be at amortized cost or at fair value, but hedging instruments will always be measured at fair value. So where these fair value changes will go and affect whether it will affect my OCI or whether it will affect my profit and loss account. To discuss that, we will first need to see what the hedge item these hedging instruments are hedging. So in case the hedge item is an equity instrument which is measured at a profit and loss account, in that case, all my fair value changes will be taken to OCI, other comprehensive income, which is against my general rule that all fair value changes will be taken to profit and loss account. So this is the only exception we have if the hedge item is equity instrument measured at fair value through OCI. Only and only if it's an equity instrument measured at OCI, then only my fair value changes will be taken to OCI. In all other cases, in all other hedged item which the hedging instrument is hedging, the fair value changes will be taken to profit and loss account, right? In case of a hedged item, we have already discussed that an asset can be at amortized cost, fair value through OCI, or fair value through profit and loss account. In case of an amortized cost, the gains and losses on the hedged item shall adjust the carrying amount of the hedged item and be taken to profit and loss account. In case of a hedged item which is measured at fair value through P&L, as the name suggests, these are measured at fair value at profit and loss account, at fair value through profit and loss account. All the gains and losses in the fair value changes are taken to profit and loss account. However, if the hedged item, I'm saying if the hedged item is measured at fair value through OCI and the hedged item is an equity instrument, or I should say, if the hedged item is an equity instrument measured at OCI, then the fair value changes are taken to OCI and not P&L. In case of an unrecognized firm commitment, this is also an eligible hedged item which we have already discussed in the previous videos. The cumulative changes in fair value of the hedged item are taken to profit and loss account. So guys, in summary, if we have to look at this slide, all the changes in fair value, whether for hedged item or changes in fair value of an hedging instrument, these will be taken to profit and loss account, except where the hedged item is an equity instrument and that too is measured at fair value through OCI. In those cases, in such a case, only fair value changes will be taken to OCI. So I'm again repeating, all the hedging instruments are measured at fair value. To see the impact of fair value changes, we have to first see what the hedged item is. If the hedged item is equity instrument measured at fair value through OCI, fair value changes will be taken to OCI. For any other hedged item, fair value will be taken to profit and loss account. And in case of an hedged item, all the fair and value changes of an head item will be taken to profit and loss account, whether it is at amortized cost, whether the item is measured at fair value through profit and loss account, or it's an unrecognized firm commitment. In all these cases, the gains and losses, or I should say the changes in fair value of an hedged item will be taken to profit and loss account. In case of an hedged item measured at OCI, fair value through OCI, will see if it is an equity instrument or a debt instrument. So in case of a debt instrument, fair value changes are again taken to profit and loss account. Only if the equity instrument, hedge item is an equity instrument which is measured at fair value through OCI, then it will be taken to other comprehensive. In nutshell, any gain or loss, any fair value changes in either in hedging instrument or in hedged items, the fair value changes will be taken to profit and loss account. However, if the hedged item is equity instrument measured at fair value through OCI, then only my fair value changes will be taken to other comprehensive income. So guys, let's quickly understand how my accounting entries will look like in case of a fair value hedge. So let's say we have bifurcated accounting entries and the losses and gains on the hedging instrument and the losses and gains on the hedged item. So in case there is a loss or a gain on the hedging instrument, let's first come to the loss on the hedging instruments. We all know that all losses are debited to profit and loss account. So in case of a loss on the hedging instrument, fair value loss on the hedging item will be debited to profit and loss account, and the financial liabilities from hedging instrument will be credited to my financial position. That is my balance sheet. In case of a gain, when there is a gain, all gains are credited to my profit and loss account. So fair value gain on the hedging instrument credit, and financial asset, because it's a gain, it's an upward movement in the hedging item. So financial assets from hedging instrument will be debited. In case of a loss, it will be financial liabilities from hedging instruments. In case of a gain, it will be financial assets from hedging instruments. Losses are all debited and gains are all credited. Let's also understand the gains and losses on the hedging hedged item. When there is an hedged item, gain on an hedged item, the carrying amount will be adjusted. That means if the hedged item, let's say it's an inventory, so we'll debit the inventory, will debit the hedged item, and because there is a gain, we'll credit the gain on the hedged item. In case of a loss, again losses are debited. Loss on hedge accounting will get debited, and the asset that is an hedged item, or I should say inventory in our example, will be credited. So friends, let us understand the fair value hedge and the accounting for fair value hedge with the help of an example. So in this example, as you can see, Ram Limited acquired an asset on 1st January amounting to rupees 10,000. So on 1st January, the value of an asset was 10,000. That is the transaction cost at which the asset was acquired. The prices of the asset may fall. Ram Limited is of the assumption that the prices of the asset may fall in future. As such, Ram Limited sold this asset in the future market and they took the hedging instrument for the delivery at 31st December 2002. So let's see what the fair value of the hedged item and hedged instruments were at different dates. In this example, on 1st January 2001, the fair value or the transaction cost of the hedged item was 10,000. The value of the hedged item on 31st December, 1 year later, was 12,000, and the fair value, or I should say, on 31st of December 2002, Ram Limited sold this asset at rupees 13,000 rupees. So my fair value from 10,000 it increased to 12,000, and from 12,000 it increased to 13,000 rupees. Similarly, my fair value of the hedging instrument as on 1st January 2001 with a delivery at 31st December 2002 was 11,000. That is the fair future price for the delivery at the subsequent year. On 31st December, 1 year later, 31st December 2001, the future price of the hedging instrument was 12,500. That is, there was a loss of 1,500 rupees. On 31st of December, because this asset was sold, as such, the hedging instrument will have to be closed as well. So on the 31st of December 2002, the fair value was 13,000 rupees. So let's see what my accounting entries will look at different dates. So on 1st January 2001, when the asset was acquired, the amount was 10,000 rupees. So as such, because an asset was acquired, asset account was debited, and there was a cash outflow, my cash was credited. So this was credited at 10,000 because this was the fair value or the transaction cost as on 1st January 2001. 1 year later, on 31st December 2001, there was a change in the fair value both on my hedged item from 10,000 to 12,000, and on the hedging instrument also there was a loss from 11,000, it went to 12,500. So let's see how this accounting entries will look like. On the hedged item, because the hedged item, the fair value increased from 10,000 to 12,000, so there was a gain on the asset. So asset account will again be debited, and the corresponding impact will be taken on profit and loss account, which is my profit and which is P&L. All the gains will be credited to my profit and loss account. Similarly, on 31st of December 2001, on the hedging instrument, because there was a loss of 1,500 rupees, 12,500 minus 11,000 rupees, profit and loss account was debited because all my losses will be debited, and the corresponding impact was taken on the financial liabilities from hedging instrument. So my financial liability from hedging instrument was credited by 1,500 rupees. 1 year later, on 31st December 2002, there was again a fair value change, upward fair value change. From my hedged item was sold at 13,000 rupees. So my asset will be debited by 1,000 rupees, which is the differential of 13,000 rupees at which the asset was sold, against the fair value as of 31st December 2001, which was 12,000 rupees. 1,000 will be debited to asset, and all gains will be taken to profit and loss account. As such, my P&L will be credited. Similarly, in the hedging instrument, there was yet another loss. The value increased from 12,500 to 13,000 rupees. So 500 profit and loss account will be debited, and my liability, financial liability from hedging instrument will be credited. So guys, on here was another entry because this asset was sold. So this cash will be debited because 13,000 there is a cash inflow, and because we have sold the asset will be credited with an amount of 13,000 rupees, which was the fair value, or I should say, at what price my asset was sold in the market. On the hedging instrument, what we have seen is there was a profit and loss account debited with 1,500, and then there was a profit and loss account debited with 500. So my cumulative gain or loss in the profit and loss account was 2,000 rupees. Similarly, my financial liability was credited by 1,500 and my financial liability was credited by 500 on different dates. So there was a cumulative amount of 2,000 rupees, that is financial liability from hedging instruments. Because this asset has been sold, we have to close the hedging instrument as well. So to knock off the hedging instrument, because my financial liability for hedging instrument was earlier credited, now we will debit with the amount of 2,000 rupees. And it will be knock off and it will be a cash settlement. So cash will be credited by 2,000 rupees. Let us see what is the overall impact on the hedged item and see what is the overall impact on the hedging instrument. On the asset, because the asset was acquired and was subsequently sold, so 10,000, the price was acquired, the asset was acquired, then there was a gain of 2,000, then there was a gain of 1,000. So asset was debited with 13,000 and then my asset was sold at 13,000 rupees. So my net impact will be zero because 10,000 asset was purchased. Then there was a gain of 2,000 rupees and 1,000 rupees at different dates. So 13,000 asset was debited. And then we credited our asset with 13,000 because the asset was sold. So the net impact was zero. On the cash, because we acquired the asset at 10,000 rupees and sold it at 13,000 rupees. So there is an incremental change to the extent of 3,000 rupees. As such, my net impact will be cash account debited. On the profit and loss account, because there was a increase in the fair value of the hedged item from 10,000 to 13,000, 3,000 was the cumulative impact on my profit and loss account. On the hedging instrument, again, hedging instrument was earlier credited by 1,500 and 500, then it was debited by 2,000 to knock off the hedging instrument transaction. So my cumulative gain or loss, the cumulative will be amount will be zero in case of a financial liability from the hedging instrument. Because there was a loss of 2,000 rupees, because my PNL was debited by 1,550 500 rupees. So my net impact on profit and loss account was a loss. As such, my profit and loss was debited by 2,000 rupees. And then there was a settlement in cash of this loss. So 2,000 was sold, and as such, the cash was credited by 2,000 rupees. So the net impact on my hedging instrument was cash account debit by 3,000 and profit and loss account credit by 3,000. There was a gain on my hedged item by 3,000 rupees. Here on the hedging instrument, there was a loss of 2,000, PNL was debited, and there was, because there was a cash outflow, cash was credited by 2,000 rupees. 3,000 gain on hedged item, 2,000 loss on hedging instrument. So my overall impact was 3,000 gain minus 2,000 loss, 1,000 rupees, and my overall cash settlement will be 3,000 gain minus 2,000 loss, 1,000 rupees. So guys, this is how my accounting entries will look like both in case of hedged item and in case of an hedging instrument. So now guys, with the help of this example, you have understood the accounting entries and where my profit and loss account will go, because this hedging instrument, we have taken a very simple example. There can be complex transactions which an enterprise deals into to hedge my risk, but for the ease we have took a very simple example to help you understand how my accounting entries will look like. Guys, before we wrap up, let's just do a recap of what my accounting entries will look like and where my profit and loss will go into profit and loss or OCI. Let's go back to my slide. So guys, as a general rule, all my hedging instruments will be measured at fair value. And to see where my fair value changes will go, we'll first see what is the hedge item we are hedging. So in case the hedge item is an equity instrument measured at OCI, all my fair value changes will taken to OCI. In case of an hedged item which is measured at which is an equity instrument measured at OCI, all my fair value changes will be taken to OCI. So as you can see from this video, only in these two exceptions, all my gain fair value changes will be taken to OCI, which is in this color. For all other cases, whether on a hedging instrument or an hedged item, whether it is at amortized cost, whether the hedge item is measured at profit and loss account, or there is an unrecognized firm commitment, all the fair value changes will be taken to profit and loss account. So guys, I hope this session is clear. I hope you have learned the accounting for fair value hedges and the concepts are clear. We will again upload a subsequent video on cash flow hedges and a separate video on net investment in a foreign hedge. So till then, stay tuned.